This is Reporting Matters. The Corporate Accounting Podcast starts now.
Imagine waking up on January 5th.
Oh, boy. The worst day of the year.
Right. It's the worst. Your global parent company, which is, headquartered halfway across the world, is suddenly demanding your pristine IFRS consolidation.
Yeah, and they want it by 9:00 a.m. sharp.
Exactly. 9:00 a.m. sharp. So they can finalize their global earnings call.
Yeah.
But meanwhile, the Dutch authorities are basically tapping their watches, right?
They are.
Yeah.
They want that perfectly formatted local statutory filing.
Yeah. And just as you sit down with your coffee, just to start reconciling the two, an automated alert just pings on your dashboard.
That's the one you don't want to see.
No, it's not. It says a routine intercompany transfer, like some intellectual property rights movement, has just flagged your entire operation.
For a potential anti-money laundering review.
Yes, under local law. And, for you, sitting in your office overlooking the Zuidas or the canals, this isn't some hypothetical nightmare scenario.
No, definitely not.
It is just the reality of a standard Q4 close.
It's the ultimate pressure cooker. Honestly, it really is. And the reason we're framing it that way is because the role of a corporate finance chief in this specific city has, it's evolved into something that would be completely unrecognizable to someone doing the exact same job like a decade ago.
Oh, totally unrecognizable.
Right, because you are managing this incredibly sophisticated intersection of, global ambitions on one side and localized scrutiny on the other.
Okay, let's unpack this, because if you are listening to this right now, we are talking directly to you.
The Amsterdam-based CFO.
Exactly. You are managing the hub. And today's deep dive is entirely dedicated to your operational reality. We're pulling from a really dense stack of source notes that are explicitly focused on the, strategic realities for Dutch corporate finance professionals.
It's just a lot to get through.
It is a lot. Our mission here is to map out the friction points that are basically defining your day-to-day existence.
Yeah, the stuff keeping you up at night.
Right. So we're talking the holding structure complexities, the massive regulatory cliff that's approaching with the 2026 statutory audit thresholds.
Which is huge, by the way.
So huge. And the tech stack you actually need to survive the SBR reporting requirements, plus the sudden, intense escalation of Wwft compliance.
Because, if we connect this to the bigger picture, taking a step back, this city is just a singular environment. It really acts as a massive magnet for global capital.
Yeah, it draws everything in.
It does. Multinational corporations, they park their holding structures here for a very, very good reason.
The infrastructure, right? The tax treaties.
Exactly. The infrastructure, the treaties, the talent pool. But that magnetic pull means the local authorities are acutely aware of the volume of capital flowing through.
They know exactly what's happening.
They know the risks. So the tension you feel every day between those sweeping winds of global finance and the specific localized gravity of Dutch compliance, that isn't an accident.
No, not at all.
It's an actual feature of the system you were operating within.
Yeah. And we have to start with that foundational architecture, I think, because everything else, the audits, the tech, the compliance stuff, it all flows downstream from the sheer friction of the cross-border holding structures themselves.
The structure is the root of the friction.
Right. The local BV serving as this anchor point for a massive international entity. And the source material highlights this as a primary challenge, managing the international tax, the transfer pricing, and just the relentless intercompany reconciliations.
Oh, the reconciliations.
Right. Why does this structure inherently generate so much operational pain for a finance team, like at a mechanical level?
Well, it comes down to fundamentally managing two completely different versions of financial reality simultaneously.
Two realities.
Exactly. The global parent requires everything to roll up really neatly into international financial reporting standards, right? IFRS.
The universal language.
Yeah, the universal language of the parent company's shareholders. It's designed to show a consolidated global view of the economic health of the whole enterprise.
But the Dutch authorities, they don't care about that.
No, they do not care about the parent company's consolidated global view at all. They care about the standalone financial health and statutory compliance of the local entity.
Under Dutch GAAP.
Exactly. Under Dutch generally accepted accounting principles.
And people outside your seat, they often assume that's just a matter of pressing a button in an ERP system to, like, switch the view.
Oh, yeah, the magic button.
Right. They assume it's just formatting.
Yeah.
Like, oh, just export it differently.
Which is just a wildly dangerous assumption.
Yeah.
Because it is not formatting. It is foundational accounting logic. I mean, the way you recognize revenue, the way you value certain assets, the way you handle leasing arrangements.
Or goodwill amortization, right?
Oh, goodwill is a perfect example. These things can diverge significantly between IFRS and local Dutch principles. So you are forced to maintain a localized ledger that reflects one set of rules and a global ledger that reflects another.
And they just constantly drift apart.
Exactly. They drift apart due to the sheer volume of intercompany transactions.
Now, the analogy that often gets thrown around, and I hear this all the time, is that you are a real-time translator working in two slightly different dialects.
Right, the translator analogy.
But I feel like that doesn't really capture the actual math involved. Because, I mean, a translator just swaps out the vocabulary.
Yeah, the meaning doesn't change.
Right. If I'm translating English to Dutch, the meaning stays the same. But here, the underlying value actually changes based on which rulebook you're using.
The translator analogy is close, but you're absolutely right. It's actually worse than that.
Yeah.
You aren't just changing the words. You are recalculating the economic reality of a transaction based on the jurisdiction looking at it.
Which is wild.
It is. Let's think about transfer pricing, because that is really where the friction turns into fire.
Oh, transfer pricing is a nightmare.
Let's say your BV is providing a centralized management service, or maybe licensing a piece of software to a sister company in another jurisdiction.
Okay, got it.
Under IFRS, the parent company just wants to see a seamless, frictionless transfer of value that ultimately just washes out in the global consolidation.
Right, because it's all in the family. From the parent's perspective, it's literally just taking money out of the left pocket and putting it into the right pocket.
Exactly. It's an internal movement. But under local rules, that local entity is a standalone taxpayer.
It's an independent legal person.
Yes. So the local authorities demand that this transfer occurs at arm's length.
Meaning you have to price that internal service exactly as if you were selling it to a completely hostile third party on the open market.
Precisely. And you have to document the exact methodology of how you arrived at that specific price.
Which takes forever.
Right. So you have the parent company pushing for a transfer pricing policy that optimizes global tax efficiency.
Keep the costs low internally.
Yeah. And then you have the local authorities demanding a localized markup that satisfies their specific interpretation of an arm's length transaction.
And as the CFO sitting in the middle, I mean, you are the one signing off on the reconciliation between those two competing demands.
You're the bridge.
Yeah, you are manually bridging the gap. Every single quarter, you are creating these massive reconciliation adjustments.
The spreadsheets are huge.
They are. You're saying, here is our IFRS profit, and here's our completely different local statutory profit, and here is a 50-page spreadsheet explaining the delta.
And that delta, that is where the operational bottleneck lives.
Right.
If a company wants to move fast, say the parent wants to launch a massive new European product line or acquire a competitor, they need the financial data immediately.
They can't wait around.
But if your team is bogged down trying to, reverse engineer a transfer pricing adjustment because the IFRS treatment of a newly acquired intangible asset directly conflicts with how it must be amortized locally, the data is delayed.
You literally can't close the books.
No, you can't.
And the parent company's agility is just totally stunted because the European hub, which was supposed to be this agile strategic springboard,
has turned into an administrative anchor. Precisely. The friction literally limits scalability. Because if every new intercompany flow requires a bespoke manual reconciliation to satisfy two different masters, you eventually hit a ceiling.
you just run out of human hours.
Yeah, you hit a ceiling on how many transactions your team can physically process before the entire system breaks down.
Which makes the timing of our next topic incredibly crucial.
Oh, yeah.
Because if you miss these reconciliations, or if your, translation between global and local rules is even slightly off, who catches it?
Well, historically, maybe nobody.
Exactly. If you were a smaller operation, you might fly under the radar of the most intense external scrutiny. But the net is widening, and the rules of who gets scrutinized are changing fast.
Very fast.
And that brings us directly to the massive cliff approaching on the horizon. The 2026 statutory audit thresholds.
Yeah, the Dutch Civil Code is shifting the goalposts. And for a lot of growing holding structures, this is the most critical strategic hurdle of the next 24 months.
Without a doubt.
The criteria for corporate reporting obligations and mandatory statutory external audits, they are being updated.
So we have to get into the nuts and bolts of this because this isn't just about like paying an invoice for an external audit firm.
No, it's way more disruptive than that.
It is about a fundamental shift in how your operations are exposed to the outside world. The source data outlines 4 distinct entity sizes, right?
Yeah, micro, small, medium, and large.
Right. And the real danger zone, the cliff we are really talking about, is the transition from a small entity to a medium entity.
Because that is the exact line where a statutory external audit becomes legally mandated.
Okay, let's break that down.
If you are classified as micro or small, you have certain reporting obligations, sure, but you are generally shielded from the requirement of a full external audit.
So let's lay out the exact parameters for a small entity. We're looking at 3 specific metrics.
Yes. Assets, turnover, and employees.
Right. Total assets must be less than or equal to 7.5 million euros. Net turnover must be less than or equal to 15 million euros. And average employees must be fewer than 50.
And as long as you stay under those ceilings, you are in the clear. No external audit required.
But the moment you step over into the medium category, the world changes.
It changes completely. A medium entity is defined as having total assets strictly greater than 7.5 million euros up to 25 million.
Okay.
Net turnover strictly greater than 15 million euros up to 50 million.
Right.
And average employees between 50 and 250.
And obviously large is just anything beyond those upper limits. Over 25 million in assets, over 50 million in turnover, over 250 employees.
Correct. But here is the critical legal mechanism under the Dutch Civil Code that drives CFOs absolutely crazy.
Well, the 2-year rule.
Yes, the 2 out of 3 for 2 years rule. An external audit becomes legally mandatory if your entity meets at least 2 of those thresholds for a medium or large entity for 2 consecutive financial years.
Here's where it gets really interesting. I mean, 2 out of 3. It doesn't matter if your headcount stays incredibly lean, does it?
Not at all.
You could have a holding company with like 5 employees doing the work of a massive multinational. But if your assets and your turnover cross those specific lines, 7.5 million and 15 million for 2 years in a row,
You're caught.
you are suddenly subject to the exact same audit requirements as a company with a massive physical footprint.
What's fascinating here is how this rule forces a complete reevaluation of your financial strategy.
How so?
Well, you are no longer just managing the P&L for operational efficiency. You are actively managing your balance sheet and your revenue recognition against a rigid regulatory stopwatch.
Oh, right, because you have that 2-year countdown ticking in the background.
Exactly.
I want to dive deep into a practical scenario here because I can easily see how a successful CFO could accidentally trap themselves.
Oh, it happens all the time.
So let's say you are managing a highly profitable BV. You've optimized the structure. Last year, your total assets sat at 7.2 million euros.
Okay, safely under the 7.5 million threshold.
Right. Your net turnover was 14 million euros. Again, under the 15 million line, you have 20 employees.
So you are comfortably a small entity, no audit required.
Right. You are operating efficiently, your compliance costs are relatively low, and your team is handling the IFRS to local GAAP reconciliations internally without external auditors breathing down their necks.
Life is good.
Life is good. But then the parent company decides they want to aggressively expand market share in Europe.
Which is what parent companies do.
Exactly. They inject 2 million euros of capital into the BV to fund a new marketing push, and they route a major new European client contract through your entity.
Okay, so watch the numbers jump.
Yeah. Your assets instantly jump to 9.2 million euros.
Over the line.
Your turnover is projected to hit 18 million.
Over the line again.
But your headcount stays at 20 because the parent is utilizing your existing lean team.
Doesn't matter. You've just triggered the clock.
Wow.
You hit 2 of the 3 metrics, assets and turnover. Year 1 is complete.
Now, wait a minute. Put yourself in the shoes of that CFO. You know that if you hit those numbers again next year, you fall off the cliff.
The audit becomes mandatory.
And an external audit isn't just like an invoice to pay. It is a massive operational disruption.
It's months of work.
Suddenly, auditors are crawling through those incredibly complex transfer pricing spreadsheets we just talked about. They are stress testing every single reconciliation between IFRS and local rules.
Looking for any variance.
Right. The risk of a finding is huge. So as a CFO, I am looking at the parent company and saying, we need to hit the brakes. We need to actively suppress our growth for the next 12 months to reset the 2-year clock.
And that is the exact tension. The local CFO desperately wants to defer revenue, perhaps delay the capitalization of certain assets, or hold off on accepting new intercompany loans just to drop back down below $7.5 million in assets and $15 million in turnover for year 2.
Just to break that consecutive streak.
Exactly. You want to break the streak.
But I'm going to push back hard on that strategy.
Okay, go ahead.
How does a CFO actually win that argument in the boardroom?
Oh, they usually don't.
Right.
Yeah.
Because the global board members sitting in New York or London, they care about EBITDA. They care about market capture.
Revenue growth.
Yeah. If you walk into a board meeting and say, hey, we need to halt a multi-million euro expansion because I want to avoid a Dutch statutory audit, you are going to get laughed out of the room.
Oh, 100%.
The board doesn't care about your Dutch civil code headaches. They view compliance as a cost of doing business, not a reason to stop doing business.
That is the reality. You're spot on. The board will almost always force the growth.
So what do you do?
Well, the CFO cannot simply accept that mandate without repairing the infrastructure. If the board says push forward, take the audit, the CFO's job shifts from avoiding the cliff to building a parachute while falling.
That sounds stressful.
It is. You have 12 months, year 2 of the cycle, to upgrade your entire financial operation from a small mindset to a medium-large mindset.
You can't just scramble at the end.
No, you absolutely cannot wait until the end of year 2 and say, well, the auditors are coming next week, let's clean up our transfer pricing documentation.
Because at that point, it's too late. The historical data is already incredibly messy.
Exactly. If you've been relying on the fact that no external auditor was going to double-check your localized reconciliations, you are in for a brutal awakening.
They're going to tear it apart.
A statutory auditor is going to demand complete, ironclad documentation for every single variance between your global reporting and your local filing. They are going to scrutinize the economic rationale of every single intercompany loan that inflated your asset base.
So how do you actually prepare for that?
It's all about the systems.
Right, because if the board forces the growth and you know the audit is coming in 2026, you can't just tell your accounting team to work harder.
No, they're already tapped out.
They're already maxed out doing the manual reconciliations. The sheer volume forces you to fundamentally change how the data is processed.
You need a lifeline.
Which brings us to the operational lifeline. If you miss those thresholds, you face an audit, and you must leverage your tech stack to survive it. Let's look at the integration of SBR and automation tools.
This is a critical evolution. The source notes emphasize the absolute necessity of standard business reporting, or SBR, workflows for your submissions to the KVK.
The Chamber of Commerce.
Right. And to understand why this matters, we really have to look at what SBR actually is mechanically.
Right, because for a lot of people, when they hear digital reporting, they think they are just uploading a PDF of their financial statements to a web portal instead of mailing a physical booklet.
Yeah, that is the old world. SBR is an entirely different paradigm.
How so?
It is a standardized digital taxonomy based on XBRL.
Which is extensible business reporting language, right?
Exactly. So when you use an SBR workflow, you are not sending a static document. You are sending a stream of data where every single financial figure is individually tagged with a highly specific piece of metadata. And that tag tells the authorities exactly what that number represents under Dutch statutory rules.
It's machine-to-machine communication.
Exactly.
But the complexity here, and this goes right back to the friction we discussed in the beginning, is the mapping process itself.
Oh, the mapping is where the pain is.
Because the tag you use for a specific line item in your global IFRS system does not automatically map one-to-one with the tag required by the Dutch XBR taxonomy.
Exactly. It's almost never a perfect match. And this is where the manual spreadsheet approach completely collapses.
It just breaks.
It breaks. If you are a small entity, maybe you could manually map your trial balance to the SBR taxonomy at year-end. It's painful, but, you know, it's possible.
Right.
But if you have crossed the threshold into a medium entity, the volume of data, the complexity of the disclosures required, and the scrutiny of the external auditor make manual tagging impossible.
There's just too much room for human error.
If you mistag a massive intercompany liability because your global ERP system categorized it slightly differently than the Dutch taxonomy requires, the automated systems at the KVK will flag it, or your auditor will fail it.
So the tech stack isn't just about efficiency. It's about translation accuracy at a massive scale.
Yes.
And the source material highlights that this is where artificial intelligence is shifting from, like, tech hype into day-to-day utility for regional audit workflows.
It really is.
And honestly, I'm always highly skeptical when the term AI gets thrown around in corporate finance.
Oh, me too.
Right. It usually just means an expensive dashboard with a glorified chatbot.
Yeah.
So how is a CFO actually utilizing AI here to handle this SBR mapping and threshold monitoring?
The skepticism is completely warranted because there's a lot of noise out there.
Yeah.
Generative AI that writes emails is not going to save your statutory audit.
No, it's not.
The true utility we are talking about here is predictive and mapping-focused AI.
Okay, give me an example.
Think about the threshold problem we just discussed. A standard accounting software will tell you on December 31st that you crossed the 15 million turnover line.
Yeah, looking backwards.
Right. But applied AI in a regional workflow analyzes your transaction velocity, seasonality, and your intercompany order book to predict, probabilistically in March, that you will breach the threshold in November.
Oh, wow. So it gives you a heads up.
It gives you the lead time to actually have that fight with the board.
It provides strategic foresight based on massive data sets rather than rear-view historical reporting.
Exactly.
But what about the actual data tagging? How does it help with the SBR submission?
A sophisticated utility AI essentially learns your specific translation dialect over time.
Your specific mappings.
Right. It ingests your global IFRS trial balance and cross-references it against the local Dutch SBR taxonomy. It looks at historical mappings and says, in the past, when an intercompany royalty fee came through from the U.S. parent coded like this, we had to apply a local GAAP adjustment and tag it under this specific Dutch reporting line.
Oh, I see.
And it does that across millions of data points in real time.
So instead of a human accountant manually hunting for the one anomalous intercompany transfer out of 10,000, the system flags the anomalies.
Exactly.
It just pops up and says, hey, this new software licensing fee doesn't map to our existing local taxonomy rules. A human needs to review this before we close the quarter.
Precisely. It reduces the cognitive load of the translation. You only intervene on the exceptions, not the rule.
That's incredibly powerful.
It is. And that ability to scan thousands of transactions for anomalies brings us to a much darker and frankly much more dangerous area of local compliance.
Okay.
Because if an AI can spot a transaction that looks anomalous from an accounting perspective, it is also perfectly positioned to spot a transaction that looks anomalous from a criminal perspective.
Right. And that is the hardest pivot a CFO has to make. You spend all this time worrying about whether an auditor is going to argue with your transfer pricing methodology, and suddenly you realize the authorities are actually looking to see if you are facilitating financial crime.
It's a huge mindset shift.
The source notes explicitly highlight the critical nature of the Wwft.
Yes.
Which is the Anti-Money Laundering and Anti-Terrorist Financing Act, for anyone not deep in Dutch acronyms.
Right.
And its fundamental shift from a compliance checklist to a core operational focus.
If we connect this to the bigger picture, you have to understand the environment. Amsterdam is one of the premier financial routing hubs on the planet.
Trillions of euros.
Trillions of euros move through the holding structure set up here, and the Dutch regulatory bodies are under immense international pressure to ensure that this infrastructure is not being exploited by illicit actors.
But the central bank and the authorities cannot physically monitor every single transaction.
No, they can't.
So what does this all mean for the CFO? It means the government is effectively deputizing you. You are the gatekeeper.
Exactly. You are the financial detective. And the shift from a checklist to a core operational focus is the most important psychological change a finance team needs to undergo.
It's not just paperwork anymore.
Right. In the past, AML compliance was largely an administrative burden. A new client comes in or a new intercompany flow is established. You gather the ultimate beneficial ownership documents, you run the names through a sanction screening database, you tick the box, and you file the paperwork away.
And if the paperwork was clean, you felt safe.
You felt totally safe.
But the source material makes it clear that having clean paperwork is no longer a defense if the underlying transaction is rotten.
No sense at all.
The emphasis is entirely on identifying red flags and active transaction monitoring. Why are the cross-border holding structures we talked about in the first section, the BVs owned by foreign parents, so acutely vulnerable to this specific kind of scrutiny?
Because to a money launderer, complexity is the ultimate camouflage.
Of course.
And a legitimate multinational holding structure is inherently incredibly complex.
It really is.
Think about what a completely legal corporate structure looks like. A U.S. parent company utilizes a Dutch B.V. to consolidate European revenues. Right. The Dutch B.V. pays massive advisory fees to a sister company in Switzerland for management services, while simultaneously receiving back-to-back loans from a subsidiary in Singapore to fund operations in Germany.
Okay, to me, that just sounds like a textbook corporate tax optimization strategy.
It is. It is totally legal and highly efficient.
Right.
But from a purely operational standpoint, that exact same structural flow layering transactions across multiple jurisdictions, utilizing advisory fees to move capital without moving physical goods, leveraging back-to-back loans, is the exact blueprint a sophisticated criminal syndicate uses to obscure the origin of illicit funds and integrate them into the legitimate financial system.
Wow. So the legitimate corporate architecture and the criminal architecture are nearly indistinguishable from a distance.
They look identical on paper.
The only difference is the actual economic reality driving the money.
This raises an important question. How does the local Dutch CFO prove that the €5 million advisory fee they just wired to Switzerland is legitimate corporate strategy and not a layering tactic for money laundering?
Right, because you can't just point to the signed intercompany agreement anymore.
No. The Wwft demands that you understand and document the economic rationale of the transaction.
That is a staggering level of responsibility.
That's huge.
If a transaction flags, you literally have to ask, why did this happen? Does this make commercial sense? You can't just be the execution arm for the global parent. You have to interrogate the parent's logic.
You have to push back.
Let's look at some tangible examples of what these red flags actually look like for a corporate CFO, because we aren't talking about suitcases of cash showing up at a bank branch in Amsterdam.
No suitcase.
We are talking about highly sophisticated digital movements.
Right. A massive red flag in a corporate setting is a transaction that lacks clear, justifiable commercial purpose.
Give me a scenario.
For instance, an unexplained change in the velocity of funds. If your BV typically processes €10 million a month related to software licensing, and suddenly you are processing €50 million in a single week tied to real estate consulting fees in a jurisdiction where you have no operational footprint.
The paperwork might be flawless.
Flawless. The contracts might be signed by the global CEO, but the economic rationale is completely absent.
Or the classic back-to-back loan scenario.
Oh, that's a big one.
The parent company tells the Dutch B.V. to take out a massive loan from a third-party entity in a high-risk jurisdiction, heavily collateralized by assets that don't seem to match the risk profile, and then immediately funnel that cash to another subsidiary.
Yes.
If you just process that without asking why the parent didn't fund the subsidiary directly, you are acting as a blind conduit.
And if you act as a blind conduit, the liability rests on your shoulders.
Wow.
This is the hardest pill to swallow. The regulatory authorities are increasingly piercing the corporate veil.
They're going after individuals.
Yes. If your BV is found to have facilitated illicit flows, the authorities aren't just going to fine the faceless parent corporation. They're looking directly at the local directors.
That's terrifying.
They are looking at the CFO, who signed off on the local statutory filings, and the Wwft compliance reports. If you miss the red flags because you treated it as a checklist rather than actively monitoring the operational logic, you face personal criminal liability.
And this brings us full circle back to the technology.
It does.
Because if I am that CFO and I am personally liable for understanding the commercial rationale of every transaction, I am absolutely terrified of the sheer volume.
You should be.
A mid-sized holding company might process tens of thousands of intercompany and third-party transactions a month. I cannot manually interrogate the economic rationale of every single wire transfer. It is physically impossible.
Which is exactly why the AI utility we discussed for SBR mapping is seamlessly integrated into Wwft Defense.
To automate it.
You cannot do it manually. You must rely on algorithmic transaction monitoring. The system builds a baseline of what normal economic activity looks like for your specific BV.
It learns your habits.
Exactly. It understands the typical jurisdictions, the standard counterparties, the expected volume, and the historical transfer pricing markups.
And when something breaks that baseline, even if it maps perfectly to the SBR taxonomy and balances in the IFRS ledger, the AI flags it purely on behavioral deviation.
That's exactly.
It stops the wire and says, this real estate consulting fee to this specific high-risk jurisdiction is a 99% deviation from our historical operating model. CFO review required.
It forces the human critical thinking exactly where it is needed most. It allows the CFO to act as the ultimate judge of economic rationale without being buried in the noise of millions of routine data points.
It is an incredible web of interconnected pressures. Let's take a moment to synthesize exactly what we've walked through today, because the reality of this role is staggering.
It's a lot to carry.
As an Amsterdam CFO, your daily existence is defined by balancing opposing forces. You are absorbing the sweeping demands of global IFRS structures while grinding through the intense, localized friction of Dutch GAAP reconciliations and transfer pricing scrutiny.
Yeah.
You are forced to operate as a strategic forecaster, meticulously tracking your asset and turnover metrics against the impending 2026 Dutch Civil Code thresholds.
Fighting those boardroom battles to manage growth against the threat of a mandatory statutory audit.
Exactly. And to survive the sheer volume of that reporting, you are abandoning manual spreadsheets and implementing advanced SBR workflows, leveraging predictive AI, not just to format data for the KVK, but to fundamentally translate your global reality into local compliance.
And hovering above all of that technical accounting work is the massive, unforgiving shadow of Wwft compliance.
Yes, you have been drafted as a frontline financial detective, personally liable for interrogating the economic rationale of the cross-border flows moving through your hub.
That's exactly right.
You are using the exact same technological stack that maps your tax reporting to hunt for behavioral red flags in an environment where legitimate tax optimization and illicit money laundering look nearly identical.
It's a thin line.
We tailored this deep dive specifically for you because understanding how these four distinct pillars lock together is the only way to navigate this city. The friction necessitates the tech stack. The tech stack monitors the 2026 thresholds, and those same systems provide the forensic defense to keep you out of legal jeopardy.
It is a profound evolution of the profession, and looking at the trajectory of these regulations, it leaves me with one final lingering thought for the listener to consider.
Oh, I like a lingering thought.
We have seen how Wwft compliance has shifted from an administrative checklist into the core operational focus of the finance team. And we have seen how AI is moving rapidly from conceptual tech hype to absolute indispensable day-to-day utility for statutory audits and behavioral transaction monitoring.
Yeah, you can't live without it now.
Given the sheer acceleration of regulatory scrutiny, it makes you wonder, will the Amsterdam CFO of the 2030s spend more time managing algorithmic compliance bots and conducting forensic behavioral investigations than actually analyzing traditional financial ledgers?
That is a brilliant and honestly slightly terrifying thought.
I think so too.
The CFO effectively transitioning into the Chief Forensic Officer. It requires a completely different mental model. You aren't just an accountant keeping the score anymore. You are a translator negotiating between global ambitions and local laws.
A strategic diplomat fighting the board on growth thresholds.
Exactly. And increasingly, you are an investigator tasked with proving the purity of the capital flowing through the canals right outside your window.
It's a whole new world.
It really is. Thank you for joining us on this deep dive. Keep pushing back on the numbers, keep an incredibly close eye on those thresholds, and we will catch you next time.